equity is assets minus liabilities. It's the portion of the company that belongs to the stockholders. And then it's made up of different aspects. So what I'd like to talk about now is a little bit about what stockholders equity is all about, and how to read a stockholders equity statement. So we talked previously about the idea of contributed capital versus retained earnings. Remember that contributed capital is investment put into the company by its shareholders, whereas retained earnings is earnings that were kept in the company, in other words, profits that were not distributed as dividends, reinvested earnings, if you will. Whatever you want to call them, whether you want to call it contributed capital or retained earnings, it's all part of stockholders' equity, and that all belongs to the stockholders. Now, you can have basically 3 different kinds of stock, and one of them isn't really stock, it's negative stock, believe it or not. You can have negative stock. The 2 basic kinds of stock are called common stock and preferred stock. Very few companies actually have preferred stock. I'll talk about it in a moment. So if most companies, and this is 99.7% of companies probably, have one class of stock, and you could call it capital stock, or you could call it common stock. And this is just the typical kind of stock that the companies issue. So when you look on the, when you look at stock listings and things, that's common stock that we're usually talking about. There's a special kind of stock called preferred stock. Preferred stock is preferred in the sense that when a company pays dividends, it first pays dividends to the preferred stockholders, and then if anything is left, it pays it to the common stockholders. So preferred stock usually has a percentage associated with it. Let's say you had 7% preferred stock. 7% preferred stock would pay a dividend of 7% times the value of the stock, and pay that to all the preferred stockholders. Then the rest of the dividend goes to the common. Now, so preferred gets first order when dividends are paid. The other situation where preferred stock is preferred is a situation where a company liquidates, goes out of business. So in a liquidation, or especially in a bankruptcy, if you can pay off all your stock, if you can pay off all your liabilities, and there's still money left after that, then you would first give the money to the preferred stockholders, and then anything left would go to the common stockholders again. But it's a very unusual situation. I don't know why accounting courses love to talk about preferred stock, but they do. But it's actually very rare. Common stock is the one kind of stock that companies offer. Now, a lot of companies have more than one kind of common stock. They may have something like, sometimes you'll see Class A common versus Class B common. And then the different classes have different values, or they may have different voting rights and things like that. And that's a little more common, in which case they're all common stock. Some terminology is very important. You have the idea of par value, and this confuses a lot of students. So it's worth following what I'm going to tell you in a moment to explain this. Par value stock is nothing but an arbitrary value attached to the share of stock. That's all it is. It's a completely arbitrary value. So what you may see is, you may see something like par value $1. If the stock were to be issued for, let's say, $20, there was a company in an initial public offering, first announces, does the initial public offering for $20, then the par would still be $1, and then the remainder, which would be called additional paid in capital, PIC, would be called, would be the $19, would be the rest. So you could say this $20 that's received, that's contributed capital per share, right, would be split in 2. One portion would be common stock at par, $1, And the other portion, additional paid-in capital, would be $19 a share. So the way to think of par value and additional paid-in value capital is that it's a split off of contributed capital. Contributed capital gets split into two pieces. One piece is the par value, which is an arbitrary amount, and the other piece, additional paid-in capital, is the difference. So you issue stock for $20. The $1, if that's the par value, goes to par value. The other $19 goes to additional paid-in capital. It's really just an accounting numbers kind of thing, because this way, when you look at total common stock, you can divide by the par value per share and figure out how many shares were issued. That's probably the only reason why it's done this. I think there's a legal technicality involved in par value also that rarely has any relationship to reality. So I kind of give you the formula here. Something else here, and then or you know what, let's try this out now. Oh, look at this. I didn't give you the oh, this is on page 107 of the book, which is not shown here. Okay. But you got it on page 107. I'm sorry, I didn't copy it off. And actually, I don't even have it on these sheets. AEO, are you familiar with AEO? It's American Eagle Outfitters. So what we have there is, you know what, I should find it. No, but it's all the way, all right. What we have with American, you know, let me dig it up. January 29th, 2011. One second. This is how easy it is to look up financial statements. Now, when I was a student, in the ancient days, we used to have to go to the library and look them up on microfilm. So this is, I have January 29th, 2011. I assume this is at 2011. There we go. Okay. So here you can see this is a statement of stockholders' equity for American Eagle. And it's kind of small. Guess I can make it larger. So this is a statement of stockholders' equity for American Eagle. And here you can see this is what we're referring to right over here. You can see that there's columns for the number of shares outstanding, just the number of shares, that's common shares. And here you can see the common stock and contributed capital. That's the same as additional paid-in capital. And here's retained earnings, treasury stock, and something called accumulated OCI. And it all adds up to stockholders' equity right here. Now the ending numbers are the same. This is the information right here. The ending numbers just happen to be the same as on the balance sheet right over here. So here you can see the balance sheet, and it gives you information about common stock, contributed capital, accumulated other, retained earnings, and treasury stock. So here you can see that the par value of American Eagle, of AEO, is 0.01 cents. So let's try out some of these questions here. The par value account is titled common stock here or contributed capital. Here you can see it's called common stock. And what is the par value of American Eagle? It's 1 cent per share. And the additional paid-in capital account is, what is that titled here? They use the term contributed capital, not additional paid-in capital. And they're really synonyms anyway. So January 29th, 2011, how much was reported common stock at par? How much was reported as common stock at par? So again, we go to our statement of stockholders' equity here, and you'll see that there's a column for common stock. That is common stock at par. So going down to year end, you see January 28, 2011, it's $24.96. And that's in thousands, so that'd be 2,496,000. I don't think it's 1,000. It seems very low. Oh, that's just common stock. 2,496,000 was reported as common stock par. And how much was reported as contributed capital? Again, we go here. You see there's a column for contributed capital. That's additional paid-in capital. It's 546,597. So that goes in right here. For total contributions of, that would be the total of these two. Because just like before we divided 1 plus 19, here we're dividing common stock plus contributed capital, which comes out to be 549,093. And again, remember what these numbers are. These are in thousands, so it's 549,093,000. That's the total contributed capital of the company. Now, AEO purchased common stock in the following year, it says. So, repurchases of common stock, if the company issued common stock, in other words, sold stock, that would increase common stockholders' equity. But if it bought back common stock, that's called treasury stock, then that would decrease stockholders' equity. And the amount of stock that it repurchased in 2012, see here, now I got the wrong one. And I have 2013. But you can see here that there's reissuance of repurchase of common stock from employees. That's a purchase of treasury stock. And there's a column here for treasury stock. So this here happened to be it's interesting, they changed the number. So the number is different from the book. Okay, but here it's 16. Oh, here we go. It's these two figures. Repurchase of common stock. Repurchase of common stock. It's these two figures. So this would be 17,349 is the sum of these two. In your book, it's written as one number. We combined it to keep it simple. So that would be 17,349 as a repurchase of treasury stock. And then it reissued treasury stock, which would increase treasury stockholders' equity by the amount that it issued was, let's see here, treasury stock reissued 16,807 in 2012.